Hey, everybody. Welcome back to the fastest growing life insurance podcast on YouTube. My name is Caleb Guilliams. We have Dom Rufran and actually a special guest. But before we introduce our special guest, we're going to be answering a question. That's what this entire episode is going to be dedicated to, is your questions. So we take your questions and comments really, really seriously. And the question is, thanks for this video. However, can you do case studies and comparisons for older people, especially given that many people, like me, do not have sufficient retirement savings and assets? Can you do a case study for a 62-year-old wife and a 63-year-old husband, non-tobacco couple, who have a $1 million mortgage that they want paid off at either's death? Would you do the same for both? Also, is it too late for such a couple to create infinite banking for their adult kids after both pass away? Obviously, there's a lot going on in this comment, but we get a lot of questions around, am I too old? And I'm really glad that we're making this piece of content, because the short answer is no, and it depends. And so without further ado, let me welcome our special guest, Justin Gartman, who, for those of you who are new to our channel, Justin's one of these guys that loves running the numbers and loves getting technical. And so you are in for a treat, and we've run the illustrations. When I say we, Justin's run the illustrations, and we have a really good conversation for you in this episode. So Justin, welcome to the And Asset Show.
Yeah, thank you for having me here. Excited to be able to answer this question and really kind of break it down into a few different areas, because I think the question is pretty easy of, are you too old? No. But where we are going to kind of hit on is if you don't have sufficient assets, that plays a different role. And so we'll be able to dive into all of that.
Justin, before we dive in, I want to just get Dom's take. I gave my brief take on the answer. If I had to briefly answer this with no numbers. Dom, when someone comes to you and says, hey, love life insurance, am I too old? What's your framework of how you address that question?
Yeah, I love this question. And like you said, we get it often. And it really comes down to, for me, asking and starting with the question on why they want it. And if the answer is, I want it for something like infinite banking, or to borrow against and use for asset building activities, like I want to go start a real estate business or go buy real estate, and that's the only intention, I usually just say, hey, this asset's probably not for you, because you're looking probably for a magic bullet that may solve the income retirement problem. And when you're a little bit older, you also get less cash value just due to age and time and things like that. And you may not have enough time to sufficiently build it up to be a well-oiled machine for IBC tool to go buy other assets, unless you're going to throw a massive amount of significant money into it. Or you have this big bucket of money that can then be redistributed, that makes it more efficient from a tax perspective, right? And so realistically, there's a lot of ways that we can look at this. I do think that the way that they ended this with, hey, I want this death benefit to potentially pay off one of my mortgages, is the epitome of the and component of it, which then makes this a very sexy tool, knowing that, hey, I don't just value the cash value and what it can do, but I actually value the death benefit. And so if somebody said something like this, then we would definitely want to explore it, because it's a prime machine tool for somebody like this.
If you've been following our content, you know we like to say a lot of times, life insurance, when set up and used properly, gives your dollars more than one job. The more you understand about these jobs, the more attractive life insurance gets. And even if you're young, putting your money in cash in cash value and leveraging against it, you could argue, is that a good thing or a bad thing? When you're young, you have a lot of time. What you're saying, Dom, is if you're in your 60s, 70s, it's like, if that's the only thing you care about, there's probably other assets out there that would serve you better. But if you understand the multiple jobs aspect, it can still better your situation. I saw Bob Castalone. I heard him do an interview 7 years ago. For those of you that don't know who Bob is, he's the founder of Leap and is a legend in this space. And a lot of people that have built software came from the Leap world. So he's inspired a lot of people. And he said that needs or goals planning is kind of dumb. And he said you should always look for the most efficient thing to do with your money. And he's like, that should just be universal. Just do what's most efficient. And he talked about the most efficient plan is the thing that works under any circumstance. And so you can talk about efficiency, but if it's only efficient in a perfect scenario, that you need to factor that into other scenarios as well. And I've heard people say this indirectly, but it really clicked for me that it's like, okay, we need to help our clients be as efficient as possible, and also have them realize that there's a lot of things that can happen, especially with age, and life insurance can enhance a lot of those situations when set up and used properly. And so with that, Justin, we're going to hand it over to you and try our best to not interrupt every other word you say.
No, that's what you're here for. Y'all feel free to interrupt. And it's funny you mentioned Bob Castalone, because we'll actually be looking at Leap Calculator today as we look at a few things. So definitely see how that will play in. And then
and Justin, before you get going, as I interrupt you and I say this thing, as what Caleb said, it's only difficult for one of us to not interrupt you. So feel free, and I'll let you and the guest decide as I'm doing it right now. So
right now it's vote 1 for Dom. So
Dom, you just interrupted just to say that thing. You didn't have anything else to say other than you just interrupted just for the fact to interrupt. Okay, got it. Yeah. All right, thank you still for subscribing. We do value your time.
Yeah, that's how you just lost 3 subscribers, so we got to build it back up. But for this, we'll start off with just the simple answer to, hey, we need to pay off $1 million mortgage. So that's the fairly straightforward. Now, I don't know exactly if that means, hey, we have $1 million left that we need to pay, or hey, that's the total it started with, and clearly if they're paying, it'll be down some. But to keep it simple, just looking at how much would it actually cost insurance-wise, and this is taking in assumptions of just a standard health rating at this company. So we're going to look, if we just did a whole life policy, not designed for high cash value, but strictly designed for, hey, we want $1 million of death benefit from day one, and that's going to slowly grow. For the wife, since she's younger and a female, it would cost about $25,000, really closer to $26,000 per year for her. So a couple of advantages of that is you start off with $1 million. So if something happens in a year, there's already $1 million death benefit paid out. Mortgage could be paid off in that sense. Other thing is husband is going to cost more. So you're looking at nearly $32,000 a year for that. So that's different than what we would normally design high cash value. That's going to be a straight death benefit, pretty much all base. And so would have its advantages. Now, not much flexibility, but that would hit the death benefit part there. If that's the main goal there, would just be a matter of, hey, is this affordable based in the budget and everything like that. So any questions there either?
Yeah, my question would be, let's say life expectancy is 84. Is it reasonable to say that the death benefit just stays level, so you're keeping it at a million bucks? And then what would the cash value be at this person's 84? You could use the wife or husband. I'm just curious. It's like you're not designing this to be max funded, but there's got to be some cash value available at that age.
All right, yeah. So to answer that question, if we get to, say the husband makes it to 84, at that point, his death benefit would not have grown much. Should be just over $1 million, almost $1,030,000. And cash value wise, he would have about $775,000 of cash value. So does build up cash value. That's what it's going to do. Not as fast as what it would. And then also that death benefit, I know normally if you've watched, it's going to grow quite significantly. When we start off high, it's not going to grow as much. And then the wife clearly would have a little bit more, because she's a little younger, and it would be slightly more efficient there.
And so again, just to summarize, you're designing this just from a pure death benefit play. While this is actually an example, like that could be a good play. And another assumption could be if they live to 80, their mortgage will probably be way less than $1 million. Even with Trump's 50-year mortgages, it could still be less than that. And so there's a world where some of the cash value could be supplements for other things. But I do appreciate that, because even with the base contract, the cash value is far greater than what you've put in, which I think is a testament. It's at least good to know how that works.
Yeah. So it's something that, the cash value is going to grow regardless. And that's something where would all come down to, hey, can they afford that? And is that the main goal? You could also look at a survivorship. So I know it said at either's death, if they wanted to cut that price about in half, you could do a policy together. Cash value is going to grow about the same, be about $1 million, and grow to about that. But it's only going to be, it only gets paid out when they are both gone. So that'd be a way to save a little bit on the cost of the death benefit, just to make sure eventually that does get paid off.
So a survivorship policy, you essentially get both insured, the husband and the wife, and then when the one dies, the policy's still in force, but it pays upon the second death. And you're saying that you can actually build cash value in a policy like that, potentially do things like infinite banking from a survivorship policy.
Yeah.
And why do more people not do that? Is it just because you have to wait for both to mature, as Nelson would say, before the death benefit gets paid out?
Yeah. So biggest reason I'd say is that if you think of the husband, say he's making a lot of the income or has a majority of that, if he dies, well, there's no death benefit coming in to replace that. Now, if they both are fine, then you can make the argument of, yeah, let's just have it. It's cheaper and it only pays out, to legacy. We don't want to cover the wife or the husband. And so that's really probably the biggest reason why. But otherwise, cash value, it'll still grow, gets all the same benefits. Cool. Just a matter of, hey, it's on two lives.
I think we should do more content on this, because when it comes to legacy value, estate planning, I think there's something really cool to that. And so, yeah, that's something more content to come. Please, in the comments, if you have any questions as it relates to survivorship policies, let us know, because we will be doing a video this year on that.
Yeah, I think that would be good. Something we really haven't talked about much as well. And then another thing to add is that if we are just looking death benefit and want to keep, hey, here's $1 million, and we're not thinking cash value, anything like that, we can get cheaper with some just guaranteed universal life. And so that's going to cut the cost even more, but that's going to mean, hey, you pay that every year. You're not going to be able to borrow against the policy, do anything like that. It's strictly, hey, this is for the death benefit there. But as you see, could do 19,000 instead of 25,000 on the wife, and for the husband, 24,000 a year instead of 32-ish thousand. So could save some, a matter of goals there, but wanted to kind of give both perspectives.
Yeah, I obviously guaranteed universal life. It's essentially term that's permanent. It's you just have the death benefit, no cash value, and so it's obviously cheaper, but barely. Like it's not that much cheaper. And you're talking about, you just said at life expectancy, there's $700,000 of cash value in the whole life, versus in this, it would be zero. So part of me goes like, man, I would love to see the pros and cons, because that's a heck of an opportunity cost difference. And yeah, it's interesting.
That's where, you can make the argument, why you shouldn't do that. And then we'll look at this. So this is more probably how we would look at it. Maybe you say, let's get some term insurance and get a policy that gives you a little bit of cash value and growth over time. And so this is going to be on the wife. So on the wife at 62, and give you an example of, hey, this could be the high cash value policy. Do $25,000 a year on her, $25,000 a year on the policy. And we're still adding a little bit more death benefit, but thinking, hey, life expectancy in mid 80s, let's try to get that close to growing to $1 million by that time. Now, of course, if they die 10 years in, you'll see the death benefit here is only $658,000. But the advantage here is you're going to have, at that point, $276,000 of cash value, and it's growing, as well as most likely that mortgage is continuing to be paid down too. And so looking at it from a different lens of, hey, what do you really want? Do you want the cash value? Do you want just the death benefit? Hey, maybe a combination of both, and how we can play with that there, and can do the same thing on the husband. His looks a little less death benefit over time, but if she makes it to age 89, that's where she has $1 million of death benefit at that point. So it just takes time to get there.
Justin, what was the cash value differences in regards to the one we just talked about versus something like this at the age of life expectancy 84 that Caleb suggested?
We've helped people unlock millions of dollars in hidden value just by reviewing their old life insurance policies. Unfortunately, thousands of people do not have life insurance policies set up properly, which could be costing them a lot of money. If you have a policy, the few minutes it takes to fill out our form could be the difference between continuing to waste money or unlocking serious value. If you qualify, we'll review your policy 100% for free and give you the honest breakdown you deserve. Click the link in the description or take comment below to apply. Back to the video.
Yeah. So the one, if we look at, let me look at actually the wife, because that one we're putting about 25.
And maybe you don't even need to look all the way past life expectancy. Maybe sooner, because I think if we're talking cash value, it's probably a little bit more relevant. The death benefit obviously is the thing that matters later on in life. So maybe after 12 years or so, 10 years, what is the cash value discrepancies between option A and B?
Yeah. So if I just go to age 75, and so I know that's it's going to be about $393,000 as far as the high cash value policy goes. And the other one, you're going to have about 290. So you're going to be about $100,000 ahead cash value wise over those 13 years. And it's going to be even more earlier because at the beginning, you have no cash value. So that's where you're going to be looking at as far as usable dollars, significantly less.
And the difference between the full base is you would have the initial death benefit would be $1 million, and it's safe to assume that it would stay around $1 million or slowly increase. And so that's probably the biggest difference is this initial death benefit's less than 400,000, and even at 74, it's 723. So there is trade-offs in whatever decision you make, and that's what you could look at as a strategy. And term insurance on a 60-year-old's not cheap, but potentially what you could do is supplement a $500,000-$600,000 term policy for maybe 5 to 10 years, get a permanent max funded policy, and that would be an interesting blend to look at.
Yeah, and that's where really the combination of the two and what's going to be, one, affordable, but also get you the death benefit makes the most sense. And the other thing that we didn't mention is that we stopped funding this. I just made it where you stop funding at age 80, where the other one, you would continue funding to keep that death benefit without having a drop there. And so here, eventually, I think the break-even point is really around 93, where we actually start to have a higher death benefit and the higher cash value policy than the pure just all base policy, even though we haven't funded in about 15 years in this one. So that's where long term it makes sense, but once you get to in the upper ages in your 60s, you may not have as long of a time horizon, and so we really have to make sure the short term needs are covered as well. But that answers hopefully the first of, hey, just look at the death benefit. How much can we do to cover the $1 million there? The other question I want to look at is just that beginning part where they said, like me, do not have sufficient retirement savings and assets. And so I'm not exactly sure what they mean by that. What I found is some people may mean, hey, we've saved up this much, but based on what we think we can take income wise, which, as most of you probably know, if someone's looking at income, they typically just navigate towards, hey, the 4% rule, right? And so that's kind of a baseline of, hey, here's how much income I could take. I can't live off of that much. What am I going to do? I need to save more. And so we'll look at today how we can actually look at, well, what if you could give yourself, think of it as a pay raise. We're not going to increase the amount of money that you have. We're just going to increase maybe the efficiency of the dollars as far as income goes there. So does that make sense what I'm saying there? Or
I think so, yeah.
So this, now, like I said, we're going to use the LEAP calculator. So here we're going to look at just the standard 4% rule. So you're going to see, have $1 million portfolio. I chose that so that if someone has 2 million, hey, think everything could be doubled. If you have half this, well, probably going to need to cut it in half, but just to give a baseline, again, not knowing their situation. So $1 million, we look at, let's start with $40,000 of income, and then that rises up with inflation. So the standard 4% rule to make it out these years without running out of money. And so that's going to be the starting point. Maybe that's where they looked at, they Googled how much income can I take? And they're like, hey, that's not going to be enough there. So this is what it would look like over that time with the last 20 years of market history that we have, or 20, how many years? 25 years of history here. So that's that. But as you know, they're looking at life insurance anyways. What if we add some high cash value life insurance and look at, well, let's add that to the portfolio. And this would be, think of this as the volatility buffer. And so here's what we would be able to do. We would have, now you look over here, your present value, 800,000, that's what's going to be invested, just market assets. And then over here, we're going to take and have 200,000 as far as the actual income or cash value life insurance that we have, so that we can take that as income every single year. And you see the biggest difference now is we gave ourselves a slight pay raise, because now instead of 4%, now we're going to take 4.5%. So you can look at, that's about a 10%, a little over 10% annual income that you can give yourselves by really just changing one thing there, and run the math of, hey, you're still in a good spot of, you're not going to run out of money based on history, based on that rule. And you take more income along the way.
Justin, will you do us a quick favor real quick, just to help the audience potentially explain a little bit about how life insurance is actually used? Is it, quote unquote, the words you used, volatility buffer, like what that actually even means?
Yeah. So in this case, think of it as, and it wouldn't have to be immediate, but over this time, we'd build up $200,000 of cash value. So think we have a uncorrelated asset that is not in the market, so that as market goes up and comes down, if it comes down, we have a place that we can pull money from and use. And so what happens here is, say, you see here, we start off the rate of return, which this would have been the year 2000. The market goes down. We don't really want to sell off those assets. So we, instead of pulling from there, we find another source. In this case, happens to be the life insurance cash value. And we pull money for that year that we would need from there. So the volatility now gives everything else a chance to build back up. And you see here, we'd have to do that a few times because the market started off pretty low at the beginning there.
Amazing. So what essentially you're saying is that you will be able to take more income, being able to have the power of two, right? We're having assets that are in the market, and then something non-correlated that has the stability like whole life insurance, because it has the volatility piece built into it, which would then actually come back to the beginning of what Caleb was saying, is the definition of most efficient, which essentially works in the most circumstances, regardless of volatility and uncertainty. Is that kind of correct?
Correct, yeah. Because if we look at the standard 4% rule, if the market goes great that entire time, well, great. We could have taken a lot more income, but we don't know how that's going to happen. So we want to make sure and say, hey, let's take a little more income. And regardless of if market goes bad, which I can't think of a worse thing for retirement in 3 years being down 10 or 9, 11, and 22%, but still your portfolio can handle it because you add a little bit of diversity into it there. And so, yeah, exactly what Caleb was saying. And then there's a way that now we're going to look at this, and we're actually going to be able to take a 50% pay raise from the time that we started to the time that we can, hey, potentially look at just rearranging a few things. And so with this, you'll see here, we're able to, you'll notice we have $41,000 coming from the market assets, but we've actually dropped that. Instead of where we had 800, now we have 600. And that's because saying, hey, what if we took $200,000 of it, move that into life insurance just like we talked about? But what if we found a way to get some guaranteed annuity income? So introducing, I know this is the And Asset channel. We talk a lot about life insurance. Well, let's talk about the other side of life insurance, the annuities, and look at, well, what if we could add that, give us some certainty? And you see that now we're actually taking $60,000 because $41,000 every year. And this one too, I changed one thing that we'll touch on, but that gives you instead of starting off with 40,000, you're actually starting off with 60,000, which is like I said, 50% pay raise. And so maybe you can look at that and say, yeah, $1 million is only going to give me 40. Well, technically you can find ways with some planning and moving things around to do the same and a lot more. Yeah. All right. Then we'll look at a way that we can get even more income. So let's look at kind of giving yourself a 50% pay raise of, hey, we take a little bit more of that money, keep 600,000 in the market, but let's add $19,000 of guaranteed income through an annuity plus the volatility buffer. And so if we did all of that, we take $41,000 from here, but we also have the 19 guaranteed. So we're actually taking $60,000 every year from there. And so we're giving ourselves a 50% pay raise in that sense. And so that's where lots of different ways. If you think you don't have sufficient retirement savings, retirement investments, maybe you do. It's just a matter of repositioning them the right way. And then also to kind of back up and look at what we originally started with was that death benefit. I know on here it says desired legacy 207. That's what's left with those market assets. But at the end of the day, we just looked at we could have potentially close to $1 million of actual death benefit that's going to get paid out as well. So not only can you use it for income, use it for different things, but also have the death benefit at the end of the day that helps tie it all together and make sure you cover your assets.
Which is a great game, by the way, cover your assets. But yeah, I 100% agree with all the things that you talked about. Is just having your money all in one bucket, it leaves you vulnerable, not just from a risk standpoint, from a potential tax perspective, but from a volatility and income distribution. And so you're saying life insurance and potentially annuities and equities blended all together could give you a greater outcome, more income. And then the life insurance death benefit is something that's not even really factored into this whole thing as well, because there's a legacy aspect to that. And even going back to potentially paying off your mortgage, there's a world where you could have more income, have more certainty, and have your mortgage still paid off if you structure it well. And so those are the kind of things that are tricky to answer a YouTube comment saying like, this is exactly what you should do. First of all, we wouldn't do that, but that's almost like a pitch to like, hey, you should talk to someone on our team, Justin being one of them. Let's take a look at your situation and answer the question, does life insurance, when integrated into your situation, make it better? And it's fun to look at tools and planning software to kind of validate what we're fans of, but it doesn't matter what you're fans of. It matters like, is there a path to make this better for your situation?
Yeah, I think that's where, at the end of the day, this is not, hey, here's exactly what you should do, take this amount and this amount, but just to show that realistically looking at it is that there's a way in which adding different things can make it better. And it's not about having the biggest, nest egg. It's about what's going to truly be the most efficient and potentially give you more than one utilization, such as death benefit and volatility buffer to be used there, which can kind of tie everything together there.
Cool. What else, Justin? Is there anything else you want to mention?
Yeah, I know the last question they had, is it too late for such a couple to create infinite banking for their adult kids after they both pass away? And so I think that realistically goes back to the death benefit because, after they both pass away, I think having money that can be left behind and teaching them the concept and teaching them, hey, here's what you can do with your money is going to be key. So teaching them that and then having something that can be given to them is going to be the best way. Or, of course, potentially starting policies on them and kind of having them come into it as well. So there's a lot of different things that we could look at there. But to answer the question, is it too late? Definitely not too late. It really just depends on, hey, what other assets you have to use and how you want it to fit into your plan, and we can help see what's possible.
Yeah, I'm going to open up a can of worms here, but there was someone 3 years ago that was talking to me, and they're like, hey, my mother was getting quite old and just looking for different places to put their money. And we actually just showed this person a single pay MEC policy, which I know the cash value above basis is taxable. I get it. But the death benefit is still income tax free. And when you start running the numbers, I think this policy broke even in 2 years and had like IRRs of like actual cash on cash growth of 3.5%. It was wild. And then the death benefit wasn't too shabby either. And I was thinking, I'm like, if people could do this, why in the world would you do CDs? Like, this is like a better long-term place to save your money. And there's a death benefit component. And so I just throw that out because that might be something to consider. If we're talking to someone younger, obviously MEC policies have downfalls, mainly in taxation. But when you're in your 60s and 70s, that might be something to factor in. And that is another way to look at the life insurance product as a whole and say, like, maybe the way that we structure it could fit in my situation better. And that is something that you could use strategically, because the death benefit gets paid income tax free. So you still get some tax efficiencies there, but you don't have to worry about paying ongoing. And you also, it is amazing how it's a pretty efficient contract, because you don't have to worry about it not being a mech. So
yeah, it could be. Like I said, there's tons of tools out there. Just a matter of, hey, what's actually going to work for you, and it's going to be different for everybody.
Cool. Dom, any final words?
Any final words? I do not. Justin, you did an incredible job. Grateful for you. Thank you for answering this question thoroughly. And I think that this person got their question answered. And so if this individual that saw it definitely thinks that now it makes sense for them, like Caleb said, feel free to come book a time with us. We'd be more than happy to help.
Yep. Yeah, then we can dive into the real specifics.